Hello and welcome to the Smart Money, Dumb Money Show. I am your host as usual, Keith Richards, and this is the Halloween special of the Smart Money, Dumb Money Show. So I am going to get started by introducing the same guest I had last year on the Halloween special. This is my ghoulish friend, Griselda, and she's giving everybody a big hello. So Griselda and I were looking at some charts today, and she noted a number of technical indicators that look to be scary. So I thought I would share them with you. And we're going to get right away started with a indicator that you can access for free and very readily by going on to your browser and typing in CNN Fear and Greed Index under the search engine, and it will come up with this indicator. And this indicator is actually a pretty good indicator. It's a little like my barometer. It combines a whole bunch of different tools, let's say, to come up with a extreme fear or extreme fear, greed, I should say, reading or anything in between, similar to the sectors that I have in the barometer, as you know. Now, the barometer, my tool, uses a couple other things that this does not use, such as PE ratios and seasonality. And I spend a little bit more time on momentum of breadth rather than just straightforward breadth, which these guys do. I won't go into all the indicators, but there are 7 indicators in this. As I said, PE ratio and seasonality and a few other things are not in it that the barometer uses. So I do encourage you to always read my blog. At the beginning of every month, I report that barometer reading, which recently on the November reading, taken on I think 1st or 2nd November, was moving into the higher risk zone. It was reading 2 out of 8, where 0 is extremely risky and 8 is extremely non-risky. Well, interestingly enough, over the past month, you can see the CNN Fear and Greed was reading neutral. And recently it's 76 out of 100. So very, very similar to the barometer reading, where I'm a 2 out of 8 on that indicator. This is a 76 out of 100. So it's moving into, but not deeply buried in the extreme greed level. And that tells us both of these indicators, as I noted, if you read my blog on the barometer, both of these indicators are suggesting that there's a good chance of volatility ahead, but it's not deeply buried in the high risk zone. Still something to be cautious about and a little scary, isn't it, Griselda? Okay, so I'm going to move on to some other stuff. And I want to go into my favorite of the basic sentiment indicators. In fact, I named my book Smart Money, Dumb Money after this indicator because I like it so much. It's a good heads up. Again, it's not necessarily a coincidence sell indicator. As you can see here, this is where smart money did not like the market as much as dumb money, and yet the market kept climbing until it finally peaked and fell. So it gave us quite a heads up there, but boy, you wouldn't want to have reacted to this signal or you would have missed out on an awful lot of upside. So just keep that in mind. Normally it just spikes, and this is a good example. Back here in July 23, it spiked and it led into a pretty good downdraft. That spike was there for a while though. So keep in mind that these indicators can sometimes be very accurate. Like here it led into a short sell-off, and most certainly this one, mid 24, led into the sell-off in July right there. But recently we're getting a spike down, and it's not as deep as some of these others. So again, it's sort of like what I'm suggesting is that, like the barometer, like the CNN Fear and Greed, it's showing that people are getting a little bit too confident on the market, but not deeply crazy about it. So it's just a be scared, as Griselda would tell you, be worried, but it's not that bad just yet. So just keep an eye, as I like to say. So one other indicator I'm going to look at on this page, and then I'm going to go to some other stuff, is the AAII bear reading. So this is American Association of Individual Investors, and it looks at the number of bears in their community. They have thousands of members, and these members are looking at how they feel the market's going to act in the next 1 month, 3 months, 5 months, whatever it is. They have a series of questions they ask their members on a regular basis to respond to, like, what do you think the market's going to do in the next 3 months? That kind of question. And then we can track both the bulls and the bears, like how many are optimistic versus pessimistic, or just look at the outright number of bears, and you can see the number of bears down here. It's very few. It's only 20% of their number surveyed. The other 80% were either neutral or bullish. And that often leads, as you can see, into volatility. So even when there's too many bears, that leads into great opportunities to buy. Too few bears, like we have right now, it can often lead into sell-offs of various degrees. So just be aware. We have here, that was a pretty good signal right there where I circled. It led into a bit of a sell-off. That was a really good signal, led into a strong sell-off. And this was quite deep. This was back in 2018. And anybody remembers Christmas of that year, December, the market fell pretty good. So it was a good indicator. So we're getting, a spike, not a cluster like we had here, which maybe indicated a sell-off in 2022. But we're getting kind of a spike, and that might indicate in the coming weeks, even maybe by the time you watch this video, because I'm recording it on the 15th of October, not sure when you will be seeing it, but any of these indicators might suggest that we're in for some turbulence. Okay, so I want to cover a couple of other indicators, and that is the VIX on equities versus the spread on junk bonds. Now, just to give you some thoughts, when people are buying junk bonds confidently, the spread shrinks because they're saying, gee, I don't need as high a yield because I'm confident about the economy, and I think these small companies that junk bonds represent will do okay on average. If I buy like an ETF or something, I can tell that junk bonds are doing okay. All right, so this is a indicator of the spread on junk bonds, meaning that the premiums have picked up. Bond traders, especially in junk bonds, are getting more relaxed about the market, the junk bond market, that is. And meanwhile, equity traders are getting less relaxed. They're more fearful of what's going on. And so the VIX goes up. They command a greater premium on options. And that's how we tell they're getting more nervous. Because, yeah, they want in on the market, but they want some protection, and they'll pay up for that protection. So let's look at the, this is the PE ratio of the S&P 500. And if we go way back to the late 20s and early 30s, you guys might recall that this was called the Great Depression. And you can see that a spike in the PE ratio, which got in and around the 25 level, which back then was considered very high, it led into a severe crash, as you guys know. So it went from fairly complacent, I should say, levels of PE ratio very low to very high at that time, and that led into a crash. 2001, we saw a tech-led crash, and the market saw a PE ratio of around 45 at the peak. And in 2008, this was the real estate and oil bubble, but it was mostly the subprime and banks and real estate and whatnot bubble, and the PE ratio went through the roof. It went into levels that it had not been seen before, and of course we saw a very strong bear market in 2008 that really didn't recover until 13. And then finally, everybody blames COVID for the 2020 markdown, but really the market was set up. PE ratio had spiked quite high, as you can see, and then along came, the excuse, which I always like to say, the market's like a balloon, and it looks for the the cufflink like I have on to scratch the balloon and pop it. And so everybody can blame the cufflink for popping the balloon where the balloon was already too big to begin with. And that's what happened in 2020. Yes, COVID caused a lot of grief on the markets for a very short period of time, but the market was set up for anything to cause that reaction. So here we are, and it's 2024, October 15th. And this is from multiple.com. You can go to that site for free. It's MULTPL, and they're showing almost a PE ratio of 30, which is getting up there. We've seen higher spikes, but you'll often see levels of 30 plus that can cause the market to pull back. So again, this is not as extreme as it has been getting to cause market crashes, but we should be aware of this. Okay, so I will stop sharing the screen and finish this by saying that Griselda and I are concerned that there may be high levels of volatility, meaning swings both ways. And I'm not necessarily suggesting that these indicators are their extreme levels enough to suggest a market that crashes or a bear market. In fact, the factors such as the upcoming election and the Middle East and whatnot are enough to cause jitters. And I think that's what these indicators are telling us, is that people are confident without paying attention to the possibilities of, let's call it black swan events, or even just regular volatility from the results of the election or the results of what's going on in the Middle East and in Russia. So I want you to keep all of this in mind as we think about the markets. I think we need to be a little scared as we come into Halloween, because the market indicators that I look at are saying we ought to be cautious. So hope you enjoyed that. Thanks for watching, and we'll see you next time.